It's been a rough few days for the US dollar. Just after breaking out of some key technical resistance levels, the greenback seems to have pulled back over the last few days, causing questions about whether the outlook for the dollar is more bullish in the near term or whether it's going to resume its downward trend. Now, a lot of the moves over the last few days is probably can probably just be put down to the fact that we saw a nice move in the run up to this, and this could just be a slight correction of the move. As we can see on the US on the euro dollar chart here, we actually saw a nice move down below the head and shoulders of a head and shoulder pattern, be below the neckline of the head and shoulder pattern. And following that, we didn't gather enormous momentum. We did run into support relatively quickly, but this is still a very significant breakout that we've seen after such a long run up since March of last year. So we've seen a bit of a pullback, but we're still in some interesting zones that could potentially be rotation points and continue that bearish breakout that we've seen in euro dollar. We broke through 121. That was the first key test for this currency pair. But as you can see from the key fib levels here, 120, 150 and 122 are equally important. And 120, 150 in particular, where we're currently seeing resistance, I think is a really interesting area of resistance for this currency pair. We have the 55-day simple moving average, which crosses around this level. This is also the 50% retracement of the move from the 2021 high to the 2021 low. So as far as fib levels are concerned, this is clearly a key one. And the fact that we're seeing this resistance around this level could be very important. If we do push above this level, though, 122 is the kind of the last line really as far as this pair is concerned. And the reason for that is because not only will we see a break of the 61.8 fib, we'll have seen a break of the key moving averages that I've just highlighted as well, but also that would be a break of that most recent shoulder, the right shoulder of that head and shoulders move. So a break above that would suggest that the head and shoulders itself has potentially been invalidated and suggest that the downtrend in the US dollar has potentially resumed already after such a short period of time. So I think these are the levels which we're going to be keeping a very close eye on. A rotation down off of 120, 150 or 122 could see the move that was building prior to the last few days accelerated. As far as the key fundamental drivers, the one that stands out today is the US inflation number, and that may have been released by the time you view this video, but that's one that could potentially cause a little bit of movement in the US dollar, especially if we see rises in inflation, which could potentially spur once again talk of potential tapering and maybe over the course of a month or two fuel taper tantrum talks once again. But the Fed has been very clear in its position that it's willing to look through temporary inflation and that it is going to be more flexible with regards to inflation in the future compared to what it was in the past, allow for a little overheating with regards to its inflation target, and therefore be slower to taper their asset purchases and raise interest rates. So this is one area that we could potentially see some movement for the US dollar. But like I say, those key technical levels are the ones I'm keeping a very close eye on. At this moment, we are still in bearish territory, even though we did move above that 121 neckline once more. But a move through 122, and that could quite quickly change.